In today's video, we're going to break down the home buying process step by step. So if you're a first-time home buyer, or even if you're an investor or have bought properties in the past, you want to watch this video because things are changing all the time. The bank's guidelines, debt to income ratios, all that good stuff changes every single year and sometimes every single month. Watch this video to understand the home buying process from start to finish. And again, if you're a first-time home buyer, you're going to find a lot of value in this video. So like and subscribe. First step when you're buying a home is getting pre-approved. I can't tell you guys how many times I get a call on the weekends or throughout the week. Hey Roger, oh man, I saw this house that's really cool. It's $1.8 million and I want to put an offer on it. And these are clients that I've had preliminary conversations with, and they're looking at different price ranges, but maybe we've talked about 5, 6, 700,000, and all of a sudden they want to look at houses that are over $1.5 million. So the first step is getting pre-approved, because that way you know exactly what you qualify for and you're not wasting time looking at things that may be outside of your budget. So what does the pre-approval process look like? We're going to break it down one by one. In general, there's 3 things that are going to decide what you qualify for. So obviously the number one thing, the most important thing of all, is your income. How much money do you make? So if you're applying by yourself, or if you're applying with a spouse, if you're a W-2 employee and you work at a company and you are a salaried employee, that is obviously very simple and straightforward. If you make $120,000 a year, your income is $10,000 a month. If you make $100,000 a year, then your income is going to be $83.33 a month. So in that situation, it's very simple, straightforward, easy to calculate. But what if you get bonuses? What if you get a bonus, a year-end bonus at the end of the year? What if you're commission-based? What if you're 100% commission? Or you have a salary and then you have a commission on top of that? All of these things can make the pre-approval a little bit more complicated. Again, this is why you want to get pre-approved, because the guidelines that the banks have created around bonus income, overtime income, can actually make or break your loan. Again, at any point in this video, if I talk too fast or you don't understand, please feel free to pause, rewind, and watch it again just so you understand. So salary portion, simple. Now, if you have commission or bonus, the bank usually wants you to have bonus income or commission income for at least 1 year without any gaps in between. So that means every single month you had to be getting some kind of commission or bonus income. So I recently had a client who was getting bonus, and then for 3 months he was not getting a bonus, and then started getting bonus again. And without that bonus income, he didn't qualify, and that was a deal killer. So that actually also applies to overtime income. If you're relying on overtime income to qualify for a loan, then you have to be getting overtime income consistently every single week for a year. Now, what the bank's going to do is, if you've been getting overtime, bonus, or commission for over 1 year, the bank will average how much you have been getting, and that's going to be your bonus, commission, or overtime income. Now, if these numbers, when it comes to these 3 things, overtime, commission, and bonus, has been consistent, and you've been getting $1,000 or $2,000 a month, that's the number the bank will use. However, if your commission has been increasing month over month, then they will take an average. But if your overtime, commission, or bonus has been declining, has been going down month over month, then they're going to take the most recent lower number. They're not going to average it out. So the bank always calculates these incomes in a conservative manner. So if it's going down, they'll take the lower income. So that's if you're a W-2 employee, whether you're salary, commission, bonus, or have overtime. Now, what if you're self-employed? Now, when you're self-employed, again, things get a little more complicated. It's not as straightforward. The number one thing you want to know is if you're trying to get a conventional loan or FHA or a jumbo, anything conventional, the bank's going to use your net income. Your net income, not your gross. I've had clients who bring in multi-million dollars every year, but they have a ton of write-offs and their net income is like 20 or 30,000. So it really looks like they're barely making any money at all. So that's a huge factor. The bank's going to go off your net income. Usually they're going to take a 2-year average. However, there are situations where the bank will only take your most recent year of tax returns, your most recent net income, and not a 2-year average. And when they do that is when you have a business that's been open and active for over 5 years, and that's verifiable. So I've been a real estate agent for a long time, over 5 years. When I went to buy a house, the bank did not, and I'm self-employed, the bank didn't take a 2-year average. They only took the most recent tax return. The most recent year, they took the net income. They didn't average it with the prior year, and that's because I've been in business for a long time. So that's a little caveat if you are self-employed. If you are one of those people like my client who brings in $1 million or $2 million or more, but you have a lot of write-offs. So your net income is really low and you don't qualify. There are programs for you that are called bank statement loans, where basically the bank doesn't care to see your tax returns. All they want to see is your 12 or 24 months of bank statements, and they want to see how much is being deposited into your business every single month. So again, like my client as an example, because he has millions of dollars being deposited every single year, they're going to actually give him a lot of income because they're just looking at the deposits. They're just looking at the gross income, and they don't care to see the tax returns. So bank statement loans are different than conventional or FHA, but if you are self-employed, have your own business, you're a realtor, you're a contractor, you're in marketing, you are a consultant, and you're self-employed, a bank statement loan might be the best way to go if you have too many write-offs for your business. Okay, so the last thing I want to mention about the income portion is debt to income ratio. And again, I just want to make this as simple as possible. So basically the bank says, hey, if you're salaried and you make $120 a year, so that's $10,000 a month, the bank doesn't want your debt to be more than half of your income. That's the very simple way to put it. So if you make $10,000 a month, the bank doesn't want all of your debt to be more than half of your income. Okay? So when I say all of your debt, that means the new mortgage, if you have a car payment, if you have student loans, if you have credit cards, they want the monthly payment of all of these things, of all your debt, to be less than half of your income. That's just a general rule. With FHA, that limit is a little bit higher. So you can have up to like 55% debt. And then with jumbo loans, it's a little bit lower. It's like 45%. So again, this is why you want to schedule a call and talk to a professional like me, loan officer, and get these things straightened out, because there's a lot to digest. I've been in this business for 14 years, and I mean, I have to constantly stay on top of this stuff. So as someone who doesn't do this as a profession, navigating this stuff and Googling is going to take a lot of time, and you're better off just talking to someone. Okay. So basically that breaks down the debt to income ratio and the income portion of getting pre-approved. Now, the second thing that you have to be concerned about when getting pre-approved, trying to buy your home, and again, think of this as like a 101 class, the basics. The second thing is your credit, right? What's your credit score and how much debt do you have? So if you want to get a conventional loan, generally you want to have a 700 score or higher. If you have lower than a 700 score, your best option may be an FHA loan, but I'm not going to get too much into that in this video. Just going to give you the basics. Now, when it comes to your credit, a few things you got to consider. obviously you want to have as little debt as possible. But let's say you have a car payment, credit cards, student loans. You want to wipe out as much of that as you can before you buy a house because you don't want to be piling on too much debt. But one thing that is important to know, which does apply to a lot of my clients, is student loans. So how are student loans calculated in your debt? Now, if you're making payments on your student loans, which is pretty rare, most of my clients are on deferment, but that's going to end soon. So that's going to make it a lot harder to buy a house if you have student loans. But if you are making payments on your student loan, if you're paying $250 a month, that number is going to be counted against you in the debt to income ratio that we talked about. Now, if you're on deferral and you're not making payments, how does the bank calculate what your payment's going to be? Now, again, generally speaking, what the bank will do is they'll take 1% or 0.5% of the balance of your student loan, and that's going to be the monthly payment that they use to calculate in your debt to income ratio. So again, very simple example. Let's say you have $100,000 in student loans, right? Let's say you have $100,000, 1% is $1,000 a month, and 0.5% is $500 a month. So those are the two general ways that the bank calculates your payment, again, because you're not paying on it, right? You're on deferral, right? You got the Biden deal, you got a deferral on your student loans, you're not making any payments at all. So the bank has to put some kind of number. They can't just write zero because eventually you got to make payments on this. So they will use 1% or 0.5% to calculate the monthly payment on these student loans. So again, if you owe $50,000, 1% would be $500, 0.5% would be $250. And again, a lot of this is going to change because student loans are coming due very soon. That's going to affect how much you qualify for. So if you have student loans coming due, you might want to buy a house sooner than later. If you have bad credit or you have a lot of debt and you don't know what to pay off, we actually have simulators that can show you how to raise your score the most with paying off the least amount of debt so that you're efficient. Let's say you have only a certain amount saved, right? And you have to use that money for a down payment. But you also want to use a little bit of that to pay off some debt to get your credit score up. I can show you the most efficient way of what to pay off to raise your score the most. And guys, when it comes down to it, having a good credit score is going to get you the best rate, which is going to save you thousands, if not hundreds of thousands over the life of the loan. So arguably, credit score is the most important thing when you're buying a car, when you're buying a house. These are huge pieces of debt, and you want to get the best rate possible because that's going to save you thousands in the long run. So the last portion of the pre-approval process is your down payment. How much are you going to put as a down payment when you buy a house? So again, we'll just break down very simple, generic criteria, requirements. So if you're planning on getting an FHA loan, FHA has the lowest down payment, which is 3.5%. However, you can get a conventional loan with 5% down. I personally think that's the best option. If you have a jumbo loan, again, that's high loan amounts in the millions or 7, 8, 900,000, depending on what county you're in. You're going to need 10% for a jumbo loan. The other option is like we talked about, if you're self-employed and you're going to do a bank statement loan, again, the minimum is 10%. But again, that's very generic guidelines. They can vary. For example, if you want to do 10% down on a bank statement loan, you have to have really good credit. Some bonus material. You want to know how much, besides the mortgage, right? Besides Googling what's the rates right now, plugging in your purchase price, plugging in your down payment, and then figuring out what your monthly payment's going to be, plug in an interest rate. On top of that, you have homeowners insurance and you have property taxes. Property taxes vary from state to state and county to county. So Google what is my property tax rate in Los Angeles, Phoenix, Dallas, Memphis, Miami, New York. it's different for every single county. So you want to get an idea of what the property taxes are going to be on the property that you're going to buy. Offhand, I know property taxes in LA and Orange County are around 1.25%. So if you're buying $1 million home, your property taxes are going to be about $12,000 a year or $1,000 a month. Here in Arizona, property taxes are about half of what they are in California. So on a $1 million house here in Arizona, your property taxes are less than $6,000. They're actually around $5,000. So only $400 a month. So the same priced house in California and Arizona, you're going to be paying double in property taxes. So again, one more thing to consider when you're buying a home. Thank you guys so much for watching. Please subscribe and like if you find value. I'm trying to help as many home buyers get educated as possible. Please share this with a friend if you found value. And again, if there's any theme or any questions on anything I talked about in this video, please leave a comment. Let me know what you would like expanded on. If there's any terms that I use that you don't understand, I would love to break it down further, and I would love the feedback. So please let me know if this was helpful and if there's anything else I can expand on. Thank you guys so much. See you in the next video.